it's something that I think most people in some way, shape, or form have probably implemented, but not in the most efficient and optimized way. So there are some times where people say, "Hey, I'm just going to put money in a pot, or I'm just going to put money in I don't know, just keep it in an account or whatever." But the truth of the matter is, the whole purpose of this kind of exercise is twofold. One is to
Hello and welcome to the Woke Finance Podcast, the podcast discussing all things finance and all things finance related. It's your boy Peter, and I'm with my bro, my co-host Jax. How are you today?
Yes, Peter. How am I? How do I even answer this? Just before we started recording, you were absolutely killing me because my team lost to not a fourth, a second division team. For those that have been Walk Finance listeners for a long time, you would know that we are both football fans, and I support a team called Manchester United. And unfortunately, yeah, it's not going well for us. So I'm not too happy. Nevertheless. Yeah, nevertheless, we got to keep moving forward. I think this might be the absolute bottom, and hopefully we can recover and move forward.
Hmm.
You're still laughing at me.
The team that Man United lost to was Grimsby Town. Shout out Grimsby. The players, if you know anyone that plays for them, a massive shout out and a massive well done to Grimsby, who are 4 divisions lower than Manchester United. Yeah, man, just a massive shout out. But a shout out to our listeners all over the world as well, wherever you are, and whether you're a football fan, whether you watch other stuff, but more importantly, you are a fan of some sort of personal finance journey. Hence, why you are listening to this episode, and you've been listening to many of our episodes. So we appreciate you. We see you, recognize you, and we just want to say thank you. Jax, today, a particular topic that you revisited is a term called investment reservoir. So today we're going to be discussing what this is and how one can actually build their investment reservoir. I do like saying the name investment reservoir. So Jax, to you, I'm just going to ask you straight away, what is an investment reservoir and why do wealth managers even use it?
Yeah, so I can't lie, I actually do like that term, the investment reservoir. Yeah, so the clue is in its name. So essentially a reservoir, a natural reservoir is this kind of is it like a sea or a river that is, you capture the water for a later use, essentially? But again, the clue is in its name. The reserve is where we should be focusing on. Essentially, an investment reservoir is an account or a proportion of an investment portfolio that is in low risk investments or just cash. And essentially, you create this reservoir to basically invest later. So I'll give an example. If you are, let's say, you've got some spare money, let's say you're investing and you've got some surplus income, and you generally, on a normal basis, you would be invested in the stock market or you would be invested in some sort of investment portfolio. But let's say for at this particular moment, you've done all of that already, and you just got some surplus income, some excess income, or you look at the investment landscape, you look at the investment like environment, and you say, actually, maybe stocks may be overvalued according to your own analysis. And so for that reason, you're not really willing to absolutely buy stock at the current moment. However, you're not just going to keep that money in your bank account. You are going to allocate that money, or the word we use in wealth management is we're going to sweep that money into the investment reservoir, which is essentially just an account that you park investment money. So this money is not just savings, it's not an emergency fund, so it's not a cash reserve for emergencies, but it is money that is there to be used in a better opportune time. That is the investment reservoir.
And usually Jax does that in terms of like return the rates that you get back on that, is that usually more than maybe current savings accounts?
Yes, great question. So, recall that whenever we have like very low risk investments or cash type instruments, they will all be they'll be different. So we have some that are, let's say, instant access, like current accounts or debit accounts, where whenever you need the money, that very specific moment, you can get it. But for that very same reason, you will not earn a lot of interest on that money in your current account, right? You can also have a savings account, which is usually quite instant access as well, right? But for the same reason, because you can withdraw from this account almost immediately, again, you will not really earn a high interest on this money. Where the investment reservoir is a bit different is the actual things you will actually buy or how you would actually park that cash. There are several options available, such as things like notice accounts or very short-term fixed accounts, or people have heard of things like certificate of deposits, which stands for CDs, or term deposits, all this jargon, but all that really means is rather than just keeping money in some sort of current account, you have bought some sort of very low risk investment. And for that reason, yes, it still has that liquidity, so you can get your money back quite quickly if you need it, hence why it's a reserve. However, it may take you, let's say, 24 hours, maybe if even 48 hours. And for that reason, because you've locked up your money for just a bit longer, you earn a better return on your money, and that is the intention. That's why you have it.
Love it, love it. And I guess what sort of, when we're thinking of that and building our reservoir, I guess what sort of tools or products can we use to do this?
Yeah, so I think the most obvious one used in wealth management, and we've talked about this before, is something called a money market fund. There are also money market accounts at banks as well. But essentially, a money market fund is essentially it's like a mutual fund, just like we have stock index funds and stuff like that. But the assets inside of that fund are very, very low risk and cash type equivalents. Examples are what we call short-dated government bonds, which is borrowing money to the government for a very short period of time. It's seen as a risk-free asset, but you earn some yield on that. So probably these are the two most popular ones, money market funds, money market accounts. But you can also use, let's say, a high yield savings account as well. But essentially, these are accounts that will provide you with a better return that you're getting in just your normal current account. But you still need that liquidity. You still don't want to take risk with that money. So money market funds serve that purpose.
Love that, love that. Anything else in addition to money market funds?
Yeah, so we have high yield accounts, high yield savings accounts, very common as well, which is just another savings account where you can earn a better return. We have some people may use things like premium bonds if they want, really and truly. But I think the key understanding here is you want to be able to park the money into some vehicle that will give you a decent return, but you can get the money out quite easily, but it doesn't have to be instantaneous. So you don't necessarily need to get that money out immediately, but you can get that money out within a few days. So any product that provides you with that opportunity can be used as your investment reservoir. There are also people that will say, hey, look, even inside of your investment portfolio, let's say you've got a portfolio here in the UK, you may have, let's say, and this they're not sponsor us, I'm just using them as an example, but trading 212, let's say you're building a portfolio using this platform, it could very well be that actually you can use the portfolio, your normal stocks and shares ISA as an investment reservoir. But what I mean by that is you just keep a proportion of that portfolio in cash rather than investing it straight away because platforms like Trading 22 will give you a return on uninvested cash.
Love that, love that. And on that note, I guess when we're thinking about this, how does one kind of work out, okay, how much can I have, in my main investment, stocks, shares, etc., but then how much can I put into my reservoir?
Yeah, it's very subjective. I think the key thing is, and the way this reservoir is used often is once you have already decided on your kind of what we call your strategic asset allocation, which is essentially how much you're going to go into your ISAs, your pensions, etc. And you're doing what you're supposed to do. You've already set up some sort of structure that you are following already. Remember, the reservoir is something that you've decided to build mainly because you think maybe the investment market or the stock market is not the best time to invest, or and most likely the reason why you're building this reservoir is because you've got surplus income, or you've just had a windfall of cash for whatever reason, as you've sold something or whatever it is. However, you don't want to invest that money straight away, and you want to park it somewhere where you can earn a return until you find a better opportunity to deploy that cash. So the key thing is to just think about your own personal circumstances and think about sweeping that excess cash. One of the examples I've done in the past, and I think I know some people do this as well, is they say, for example, within their own budgets, they'd never need, let's say, for example, $2,000 or £2,000 in their checking account, their current account at any given moment because it's just for transactions. So let's say, for example, you somehow end up with, I don't know, £2,437, right? That £437 is excess, it's surplus to requirements.
Mm.
And so you can make a decision that you're going to sweep that money into the investment reservoir, to be invested into something later on.
I love that. No, I like that really because I think sometimes, as I said, it's sometimes people might have money, and they don't always know, what to do with that, or people's risks change, or as you said, they might just want to park their money somewhere as opposed to putting it into maybe certain investments, which might take a bit more risk and longevity as well. So I like the idea of just parking somewhere to park your money in those cases as well. But Jax, I'm gonna get any sort of final remarks or conclusions from you. But before we do that, just gonna give a shout out to where we're getting new listeners from. And this area is called Astana, which is the capital of Kazakhstan.
Oh, fantastic. For a moment, I thought you was going to say someone from Grimsby be listening to our podcast. Welcome to the Work Finance Podcast. You will hear of myself, Jax, and the co-host Peter. And on this podcast, we talk about all things finance related. If you want to know more about what we do, because we do serve in the community, we are more than a podcast. Head over to www.wokefinance.co.uk. That's www.wokefinance.co.uk. And if you want to engage with us on socials, we are predominantly on Instagram, TikTok, and also on LinkedIn. If you search for Woke Finance, you will be sure to find us. But welcome to the episode. I hope you were enjoying it and gaining tons of value.
Come on, come on, come on. A massive shout out to our listeners over there as well and all over the world. We appreciate you very much. Now, Jax, any final words when it comes to building your investment a reservoir?
Your investment, your investment reservoir is actually quite important, and it's something that I think most people, in some way, shape, or form, have probably implemented, but not in the most efficient and optimized way. So there are some times where people say, "Hey, I'm just going to put money in a pot, or I'm just going to put money in I don't know, just keep it in an account or wherever." But the truth of the matter is, the whole purpose of this kind of exercise is twofold. One is to get some mental accounting going, so actually being able to allocate capital to something more efficient, and secondly, actually to get a better return on your savings and your part capital. And so I think it's really important for people to start thinking about this ideology and say, well, okay, if I have surplus income, can I really find a home for that surplus income where it can actually earn a return above what you're just getting in a normal bank account? And also because you have this mental account available, you'll find that actually sometimes you would have excess money in different places, and because you know that this reserve or reservoir exists, rather than just keeping your bank account, which you end up spending anyway. You will actually sweep that money into that reserve, and that can be a very, very powerful wealth building tool. Because what I have experienced in the past and seen in terms of wealthy people is they are able to build wealth because they have capital readily available to take advantage of certain situations and good deals. One of the issues is finding a good deal and not having the capital available is quite frustrating. But if you can build this capital base in the form of an investment reservoir, then the world is your oyster should opportunities present themselves.
Love it, love it, love it. Now, this is a new topic that we've not really touched on in the years that we've been doing the podcast. So, is there anywhere where our listeners can find out a bit more, maybe books or on, is it just to go online and look, research more? So, do you have any, yeah, suggestions?
So not necessarily books, but one of the things about the Work Finance podcast is we like to spark conversations. So today you've heard about this terminology that both myself and Peter we love saying. I don't know why we love saying the investment reservoir so much, but it's to spark that thought, and for you to go and do further research. So you can learn more about the idea. It depends where you're reading it. So some books will not refer, will not use the term, investment reservoir, but they will talk about things like a cash reserve, etc. The terminology I came across the terminology in an actual textbook when I was studying for specific qualification. So again, if you are someone who's interested in studying, then of course you may come across it. But I would encourage people just to Google it, figure out what it is, understand the products that can be used for it. The most important thing is the actual concept, and the concept is really having an account that is designated to hold excess reserves to be used in an opportune time.
Love it, love it, love it, love it. Thank you so much for that, Jax. Really appreciate it as always. For our listeners, we hope you gained some value there. As Jack said, it's an opportunity to spark a conversation. And on this case, it will be on the topic of building your investment reservoir. There we have it. Last time we've said it to our listeners. Remember all,
Stay
stay woke.